but continue to see these kind of perma bear calls on U.S. housing. U.S. housing's about ready to collapse. I don't see that. I don't know where that's coming from.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I just found out something pretty remarkable. Chase, well, I mean, we all knew you went to a very prestigious institution. Well, I mean, you did. You graduated from a very prestigious institution, University of Houston. But you started off your educational sojourn, if you will. How do you like that
nice
one?
Word.
You started it off at Wharton Community College.
Pardon. Wharton County Junior College.
Wharton County Junior College. I'm sorry for misspeaking. That's
fellow Pioneer alum will be
Stone
upset
Cold.
by that.
Stone Cold Steve Austin also went there.
That is correct.
It's like an incubator of greatness.
It's Southeast Texas' finest.
We do charts and we bust beer on our head. I mean, that's what Wharton does.
That's right.
I love it. Anyway, getting to the deal. What are we? We're still about 2 minutes away from market close. Minute away here.
Minute away, yep.
Why don't you give us the rundown? We're close enough.
Yep, and it's a very flat day, so probably not going to jump here. S&P up 0.08. The Q's down 0.5%, pretty big move lower there. And then naturally, because of that, equal weight's up 1.3 on the day. Small caps up about 0.9. Mag 7 down about 0.5%. All world ex-US up 0.4. The dollar had a brutal day, down about 0.5%. Thus, the ex-US outperforming on the day. And the dollar chart looks like that, on the chart at least, looks like a bit of a breakdown. So maybe the rally we expected was a 2% rally and not more like a 5% rally.
Where'd the DXY finish?
We're at 97.37.
Haven't we got down?
It could still bounce. I mean, it's not like it's a new low. It just looks like it just created a bear flag.
Haven't we gotten down into the 96 range in this move?
Yeah, we were down to like 96.60-ish.
Yeah.
But it looked like you were building something nice. And you still could bounce back from here. But chart's not good short term, let's call it. Very short term.
You're building something nice if you're a dollar bear.
Dollar bull, it looked like you were building something nice, but it broke down the day.
Oh, excuse me. Dollar bull. Yeah.
Bitcoin up about another 1.5. Oil down again. It's about 65.50 on oil now. Gold up another 1%. Silver up about 0.7. Copper up again. And then in rates, you're down about 3 bips on the front end and 4 on the back end. That continues to surprise me a little bit. And Nvidia was down about 2.5. That was a pretty big part of what weighed on Mag 7 today.
Yeah.
Granted, it's had an insane run. So,
news came in, I guess, that California registrations of Tesla automobiles were down 21% year over year.
You can't win in California.
So naturally,
stock was up
on the day.
Where did it close there?
1.5. I think right around 333, something like that.
Yeah, up about 1%. Well, okay. It's fallen after hours a little bit, but
I hate to say it because you didn't break out to a new all-time high, but you're really close to it on gold here. You're only about 50 bucks close, away again. That was a really swift 2.7% rally on gold that just kind of popped out of nowhere.
And this is the second time, I think this year, that we were right when we started to expect a pullback. We started getting it, but then it bottomed, at least to me, before I thought it would. Like I keep expecting, something more like a 10% pullback, and it just keeps giving you, like 3 or 4, and then it's back off to the races. The strength has been,
I was thinking
impressive.
I had the privilege of going on Ninja Trader Live with Anthony Crudell and Tracy Schuchart. I've never had Anthony on, but
he's a good dude.
Yeah, he know a lot of the same people. Good buddies with Tony Greer, and Jimmy Jude and, you know, all those guys. So I never had a chance, but had a good chat with them. He asked me a question. You ever get asked those questions where, for whatever reason, it's not like it shocks you, but it just hits you in a different kind of just from a different direction. It makes you think about things a little bit differently. And he asked me one of those today. He said, do you think we're in an environment where everything, Bitcoin, stocks, metals, everything can rally together? And I looked at him and I responded, and I hadn't really thought about it. And I went, actually, yes. And I think that is the most likely thing to happen right now. And the reason I think that's the likely thing to happen is you've got more stimulus being pumped by more governments around the world right now. And bottom line is capital needs to find less ridiculous places to flow, for lack of a better term. And in that environment, yeah, I mean, I think it can flow into, my point. And so then we get done. I'm on with them for probably 15 or 20 minutes. And then we get done with them. And it's, again, if people listen to this all the time, they're like, well, I've heard you guys say things like this, but not really in this way. Where I sat back and was thinking about it a bit after the interview was over. And I thought to myself, we shouldn't expect things to play out like they have in the past. Meaning this is a completely different backdrop, right? You and I were talking about it with Pat in your office not too long ago, where we said, look, there's never been another time in history where governments the world over were unabashedly defiling their own currency valuation, right? Degrading their own currency valuations and not trying to cover it up, right? We're not trying to fill the inside of the coins with a cheaper metal and coating it here. I mean,
right. Most of us are late cycle and we're all getting after it to basically not let that wolf catch up to us.
Yeah. Yeah. And in that environment, especially when you look at where we're at, right? When you look at, the US being 130% debt to GDP now, and Japan being 230 or 250%, and all of those places stimulating. And like I was saying, you're awash in liquidity and money printing when even the Germans are talking about it. Right. But in that environment, yeah. And then you think about it, really any asset denominated in those currencies should go up.
Yeah. I mean, at the end of the day, if you ruin the denominator, the numerator goes up.
And it's not even so much necessarily thinking about it in liquidity terms. It's not necessarily ruining the denominator, but it's sort of like you've got a limited number of Dixie cups and an unlimited amount of Kool-Aid.
Right. Yeah. And that's how liquidity works. Yeah.
Yeah. And it just, and the overflow keeps happening, and you keep dumping more into the pot and more flows out, and it's got to go places. And quite honestly, when you think about it in those terms, I think that those situations, these things, now obviously you're going to have fits and starts and markets don't move in straight directions, but because that's the other perverse nature about where we're at. And I don't mean to go off on some like anti-money printing, fiat currency trip or anything like that. But when you think about where we're at and the scope of money printing, each stimulus is forecasting an additional future stimulus, right? And we've been, I'm not the only one that said that. You're not either. We've been talking about that for years. We've been proven dead right. Because every time you stimulate, you're effectively extending an artificial environment.
Right. You're keeping that debt to liquidity ratio in your favor so that it doesn't break you.
Right. And so when you do that, you don't allow the market to do the things that it would normally do, which would require market participants to undo things, right? To take capital off the table or to move or alter or whatever. Now, I do think it's going to be a little different though, because I think it's a scenario where I think you very well might be in a market scenario that kind of reminds you of the two guys hiking through the woods, and the one guy stops to tie his boots. He's like, what are you doing? He's like, well, there's a lot of bears in this country. And it's like, well, you can't outrun a bear. And he goes, well, that's why I'm tying my boots. I only need to outrun you. Yep. Right. I kind of look at that as markets like this, where in an environment awash in this much liquidity with the promise of so much more on the way via the printing press, it kind of, and again, this is nothing new and it shouldn't be shocking to anybody, but kind of sent me down this road of thinking about it and going, when you look at the pure scope of it, the pure size of it, the amounts that have been printed, the commitments to print and all that kind of stuff, I think it's highly possible we look back at this period of time and go, wait, hold on a second. You guys were worried about things going down in price? You know what I mean?
It's not a deflationary backdrop.
Well, no, and like we said, it is so widespread now that these things have to, the liquidity has to go somewhere, and you kind of toy with your own investment thesis, because you're sitting there thinking, I've got to think about things in terms of fundamentals and in value and all that other kind of stuff, all the traditional metrics. But I also need to keep my eye out for convenient and attractive pockets that investors will spot to stuff more money in, right? Looking for attractive, empty Dixie cups, if you will.
Yeah. I mean, you think about in the last year, platinum, palladium stuff, like, Sibanye Stillwater's up over 200% off its low from 2 months ago, right? 3 months ago, whatever it was. Like, if you can catch these things before everyone else realizes what's going on, like, liquidity finds its way into pockets that people don't think of them. We talked about a potential one today, which we don't have to talk about by any means because it's very new and speculative. But like, point is, you're always like looking for that empty cup.
Yeah.
Or going back to whatever it was 2 years ago, or like I guess it was one point last year, the kind of the AI data center needing power story, like to realize what that would mean for some nat gas names and some nuclear names. And, here you are, you go look at some of these SMR companies, right? Now it was not like we plugged into those whole moves, but a lot of these are now in the momentum funds and they're meme stocks. Like, so, but those were empty cups 2 years ago.
Yeah. Yeah. I mean, that was one of the reasons Palantir was an empty cup a couple of years ago.
Yeah. 100%.
Now
Robinhood was an empty cup 2 years ago.
Yeah. Now, of course,
it's a very full cup now.
I wrote it multiple times, but I always bailed out the mid 30s or I think upper 30s because it just got too rich for my blood.
That's the hard part. Yep.
And now here you are sitting at $148 or $150 a share, something like that. We've had other good wins in the meantime, but that's the other, my famous one that everybody knows is different scenario, but thought I was really smart walking away with a 400% gain or gain on GameStop in like 2.5 months because we bought it at like 9. Sold it at 43, whatever that was, feeling really smart. And then 7 days later, the thing closes at $450 a share.
To be fair, that was smart.
Yeah. Well, it was smart. Kohl's, you see Kohl's today?
That's the new meme stock.
New meme stock. Yeah. So what's the story on that one? Just a short squeeze?
I do not know. And I do not care.
The other thing I was thinking about, and this isn't me talking my own book, but you just sit there, you look at these retail and you're like, guys, if you guys are in it, you guys should do this with junior mining companies. and I'm not saying it because we're in them, but I'm
so we have some Nike. So,
but you've got at least you've got a story there. Right. And on top of that, when you consider how thinly traded, I know these guys are all into their short squeeze game, but boy, they pick the hardest names to do it.
I have no idea why.
Yeah.
Kohl's is the thing.
Just because it is. And so now you gotta get on it.
Right. That was the empty cup we should have been in, apparently.
Oh yeah. But you know what? I'm okay missing on that one. That's fine.
It's a great place to take your Amazon stuff back, though. I will say that.
What are you talking about? Oh, they have like an
you
Amazon
just take your
return?
Amazon stuff back and they just return it for you. Just no two ways about it.
Why?
You can bring it back all jacked up too.
Why?
Oh, probably because, and then they give you like some coupons or something like that. It's just a way to get you in the door. So they do it for Amazon for free probably, and they do it for you for free to get you in the door.
And they'll
give you like a little coupon or whatever to get you in this, deeper in the store.
And it
pretty smart.
Gives Amazon the benefit. One of the benefits of having a storefront,
the clean return instead of having to like come back to your house or whatever. I don't know, for me, I'm not trying to like print off the return label and like, no, thank you.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Okay, another thing that I saw today, and I'm forgetting what the name of it is, but one of the biggest skyscrapers, not the biggest, one of the biggest skyscrapers in Chicago. A few years ago, when interest rates went up, I know you and I talked about this as well. I took a lot of flack from people when I said you're going to see commercial real estate, not all of it, but you're going to see a lot of places around the country where you're going to see what was considered prime commercial real estate properties down 70 to 80%. And people are like, oh, you're a doomsday. Okay, so today, I think it's the third or fourth tallest skyscraper in Chicago. I mean, an impressive, like a movie style proper skyscraper. It was last purchased, I want to say in 17 for like 305 million. Just went today for 32 mil.
Sounds about right.
That's a big loss.
It is.
For those scoring at home, believe that's in excess of 70%.
Yes.
Matter of fact, that's about 85%, if my quick back of the envelope math is correct.
She's pretty good.
The
way those are financed is the story. I mean, it's not like these things have 30-year fixed rate loans. So
no,
and rates, I mean, they're sticky. We're still 4.5 Fed funds. Like, it's not nothing.
No, but here's the interesting thing about it. Virtually all of those loans are non-recourse loans. So if you don't even need to buy one of those properties and be thinking about it in terms of what will it be worth 10 years from now, or even 20. All you need to really be thinking about it is, do I think I can get this thing to positive cash flow for a couple of years? Because if a positive cash flows for a couple of years, you can pocket all that dough. And if it stops,
here you can have it.
There you go. You give it back. Right? And you're really insulated from risk. I mean, it's a non-recourse loan. You know what I mean? Somebody's got to eat it.
Yeah. And I'm sure there's some skin in the game up front that's not 100% financing maybe, but
well, yeah, you usually got to put 25% down to get a non-recourse
that part
loan.
would be a bit of a pain, but still.
Yeah, that's true. You got to recoup so you'd have to factor
but
it out.
But for something that was in 17, I don't know, that's a long enough time to not get killed on the thing.
Yeah, it's all about what your carry cost is. I mean, the maintenance and the upkeep of a building
mill?
like that.
How does that jingle mill work? That's a lot of keys.
Yeah, no kidding, man. I mean and I mean you're the other side of it too is your potential liabilities, right? I mean, if something goes wrong in there, you're not calling the Honeywell rep and having them come spend an afternoon, right? I mean, that can get really spendy really fast.
Yeah, you think it's a pain if you have a water leak in your house.
Whew. Well, not to mention that, if you're talking about the Chicago, not the most business friendly environment to be in either. But it's wild. And I think people are going to continue to be perplexed. I'm hearing all these increasing calls from people that I think are doing good work, for people that I think are being altruistic, for people that I think are being honest. I just don't think that they're viewing in my opinion, I don't think they're seeing the game for what it is, but continue to see these kind of perma-bear calls on U.S. housing. U.S. housing's about ready to collapse. I don't see that. I don't know where that's coming from. Do I think U.S. housing is going to be in certain areas, certain properties, certain kind of thing? Do I think it's going to have a tough time getting out of its own way for a while? Sure. I don't see a collapse.
That would take a violent move in unemployment. It's the only way, because if not, everyone's just going to sit on it, right?
And it'd have to be a really violent move, man, because think about how many of those homes are owned by baby boomers who are sitting on record amounts of assets
and equity, lots of equity,
and are financed at 2.5%,
right? And
have a mortgage payment on a 3,500 square foot home on 0.6 acres with a big, beautiful backyard, and they're paying $2,300 a month.
Yeah, a lot of the listings we're getting is the people that have bought in the last 2-3 years that thought they would be able to refi by now because they got a teaser at the on the front end.
Wait,
It's resetting. So now people are going, oh, I can't afford this. I got to sell it.
Wait a second. You mean the old real estate? Not the old. I heard it for the first time 3 years ago. But you date your mortgage, you marry your house. That didn't work out. Shocker.
And it's back in size. If you look at like kind of the rate of change for fixed rate and the rate of change for adjustable rate, like everyone's doing adjustable these days. And it seemed like a decent bet 2 years ago, 3 years ago, whatever, for however long your honeymoon period was, that you'd be fine. And everyone sold them like, oh yeah, the rates you'll be able to refi. It'd be great. And here you are, like a lot of these people are just getting resets higher, and you're like, oh well, now it's another G a month, and people are like, yeah, no, thank you, I'll list this.
Well, here's another one to look at it. Let's say, and again, I know it always sounds a little bit reckless when we play this game. Okay, but we haven't been wrong playing this game. If this was our answer, if we had this static answer to this game for the last decade, we haven't been wrong once. And that is this. If your whole apocalyptic housing scenario even starts to come true, I can tell you what's going to happen. Federal Reserve is going to go on a buying spree.
Or there'll be some legislation that softens the blow somehow. Or there'll be something.
Yep. Remember, interest rate bomb's going to go off. Nobody sees it coming. Banks are too exposed to duration. Oh, they're going to get rocked. They did. And the Fed bought it bought it from them at par.
Yeah,
and that's what I was saying about where you got to wake up to the reality that we're living in today, because it's completely different. And if you're thinking about it of years gone by, you're way off the beaten path. Does the footing underneath the housing market look shaky? Of course.
Yeah, we went up 40% in price in like 2 years during COVID. Like,
right.
Is it the end of the world if it pulls back 10?
No.
If anything, what'd be great is for it to go sideways for 5 years while wages went up 3-4% every year.
Yeah.
So that like on a real basis, people can afford housing again.
Yeah. Yeah. But the apocalyptic calls for it. I actually think potentially multifamily could be a bigger issue.
I would think so. If net immigration is going to be really low, that I would think it would put pressure on them. What's interesting is like single family starts and permits have been bad lately, and multifamily's kind of picked back up. It's a little surprising to me, but that's been what's going on the last 2-3 months.
Well, there's a big narrative out there in the multifamily space, especially a lot of the investors in it. It kind of feels similar to, and I'm not saying it's just like this at all. I'm saying the feeling is similar. You see a similar attitude around multifamily as you did individual houses back in like 08, 09, or leading into that, rather 06, 07. Meaning you talk to some of these people, and I've had this conversation with multi family investors, and everybody kind of has this. Well, you can always rent it. You can always, and you're looking at them going, guys, so what you're telling me is you found the asset class that never goes down? I'll take the other side of that. And the reason why I say that too is you won't see legislation come to the rescue to bail out a bunch of multifamily home investors nearly as quick as you will homeowners.
Yeah, exactly. It's like a religion in America. We don't play with that.
Nope.
Speaking of, I have a pretty incredible stat when it comes to housing. So for the last 50 years, first-time homebuyer cohort just demographically added 40 million people, because boomers were a huge generation, and then millennials were a huge generation.
Mm-hmm.
Well, we're kind of done with huge generations. So last 50 years added 40 million people that could buy the homes. The next 50, 4 million, from 40 to 4. So like the growth of humans to buy homes, that's dramatically peeling back. So like we've talked about this before, how we think this whole like structural housing shortage, there's not enough homes, is an overblown like thing. Expect that to get way more intense as we go forward, because people won't stop to think about the demographics, and will just look at the fact that home buildings like tails off, and they're like, oh, this is a crisis. I'm like, no, like Gen Z is a lot smaller than Gen Y was. Like, it's just pretty simple.
Yeah. Well, and factually speaking, one of the most irritating things about that meme that was going around, factually speaking, it just wasn't true.
Yeah.
About, we're way low a supply on homes. You're like, no. Actually, you just got back to even, right? Like
right.
you
People
just
ignored the one side of the data and looked at one side and decided there was a giant shortage.
chart crimes, man.
Yeah. Turns out doors per head, it's not that bad.
No, it's just not bad at all. What else you see? Do we have any big data that came out today at all?
No big data. Bunch of like just regional surveys and stuff. It's a very lame week for data.
Something I'm interested in, as everybody's going to roll their eyes when they hear this. We got Google earnings out tomorrow. I have no real insight into, no real thoughts. I just know that I hate even talking around earnings. It just
I just have no idea. That's always my take on earnings. All earnings.
Yeah, it just feels like a compressed spring. Interesting though to see some really good reviews coming out. I haven't gotten a chance to read them. I know you haven't either yet, but some good reviews coming out on the Google Pixel 10. Again, everybody will roll their eyes about that too. It's been stealing market share from the iPhone. So, granted, small amounts.
Yeah, it had a nice run. I guess the last few months kind of flipped back to iPhone.
Well, that wouldn't surprise me, considering the brand new phone.
But new product.
Yeah,
maybe you get another ramp. I don't know. You know me. I have this theory that the Pixel is going to start gaining in a meaningful way on the iPhone, but we'll see. There's a lot of work to do.
I think it should. Boy, there's a lot of, that's it. Now, they haven't really shown, they've innovated way better, but in terms of them pulling rabbits out of their hat, they kind of remind me, it kind of the same frustration you might have if you're a longtime Apple shareholder.
Right. Executing is just the problem.
Yeah.
The ideas are there.
Well, and to be fair to Google, they actually do execute. I mean, they're still growing. I mean, they're the same size as Apple and they're growing at 3 times the rate. So, I mean, tip of the cap there. I just mean, the same frustration you get with Apple not innovating is kind of the same frustration you get with Google not pulling rabbits out of their hat, meaning you've got this unbelievable ecosystem with so much pin up and hidden value, and you're expecting things to happen there, right? Synergies to be found. And again, I mean, we're talking about a $2 trillion company that's growing at 13%. So I'm not taking any starch out of them, but
if you have phones and search and email and a browser, and if you have all those things and a phone and you have
cloud,
right, and you can't stack them all into like a just free for all, like one mega product that everyone just decides they have to have for $300 a month or something, like what are you doing? Like Perplexity has beaten them to an agentic browser. It's Chrome based, but they shouldn't have allowed Perplexity to beat them to that.
I don't understand.
Perfect example.
I don't understand why they haven't tried to buy them.
Yeah, other than
antitrust.
Unless it's that, I don't get it. And to be fair, it does sound like Perplexity doesn't really want to sell too hard, but I'm sure at some price they would. And they've talked to Apple and they've talked to one of the other ones. Who is it? Talked to somebody else. Can't remember now, but we'll see. I don't know.
I mean, I'm sure they're looking for a really big number.
Yeah, clearly, because they've had 2 mega suitors and they basically stiff armed both. I love that though. I love that they're not bowing out early or for cheap.
I gotta believe the number they want is north of 100 billion.
I mean, you're valued under 10 now, so that would yeah. But I mean, I wouldn't want to sell it for less than that if it was mine. You know what company I would do? I'd pull that trigger on right now if I was running that company. Apple, and I'd fund it via equity sale. Well,
I'd
why
sell
not?
stock.
Right.
Oh, I'd give it. Yeah, heck yeah, we'll sell the stock. $100 billion. I mean, what is that?
It would immediately make them way better to their user base.
Oh, and it's like 2.8% of their market cap.
Right.
And I mean, think of the way they could monetize that, integrate that into the iPhone. They won't do it though. These late cycle companies that I very much think Apple's like that. I feel like it's IBM 20 years ago, where you're looking at them going, what are you doing? Well, we don't want to mess up a good thing. And by doing that, you will.
Right.
You are right now.
That's what's impressed me so much with big tech is how, other than Apple, is their ability to disrupt themselves is mind blowing.
I know, and continue the growth rates. I mean, to look at Microsoft And to think of what is Microsoft's annual revenue? Do you have that?
I can find it pretty quick.
But to look at Microsoft and look at the sheer size and scope of that company and to still see them growing at the rate they're growing at, I mean, the valuation doesn't make a lot of sense to me, especially when you compare it to some of the other companies out there, but like Google. But I mean, it's, a company that big still growing at that rate. What was it?
For fiscal year 24, it was $245 billion. And that was 16% growth over 2023.
And what was Google's 2024 revenue? Are they bigger than Microsoft too? I haven't comped them to Microsoft. Yeah, they're way bigger than mine. There's another valuation that'll make your head hurt. I didn't realize.
Yeah, $350 billion.
Yeah, significantly.
And that was at 14% growth. So they're basically growing the same too. Now, I think earnings wise, I do think Microsoft clears more, but
yeah. You mean more total?
I think net income may be better for.
You think net income's bigger for Microsoft? I thought Microsoft was right around like 33% margins or something like that. Maybe I'm wrong, but I thought they were right around there. I thought they were like at 32 and Google was like at 29.5.
Well, let's look.
Anyway, it's fascinating to see the premium that.
So Google cleared $100 billion and Microsoft 88 last year in net income.
That'd be another shocker for people. I bet you if you ask the average person who makes more revenue and profit per year, Microsoft or Google, I bet you 8 out of 10 people would guess Microsoft.
And Google's was a 36% growth year over year, and Microsoft's was 22 on net income.
And yet Microsoft's worth what, 65% more, 70% more? Something like that. I mean, Google's trading at 1.8, 1.9 trillion. Microsoft's at 3.7. So no, you're almost double. Yeah, I mean, look at the revenue and the earnings metrics, and Microsoft
3.8 and 2.3.
Yeah, that's wild. That is wild. Anyway, what else yet? Do you have anything else before we wrap up here?
No, I don't think so.
Nothing else to. Yeah, it's kind of waiting to see what happens on the tariff front. Trump announced a deal with the Philippines. That's not going to move any needles.
Indonesia. Yeah, Philippines got a 1% off coupon from 20% tariffs to 19.
Oh, there you go. So we did them a solid. Huh?
You're welcome, y'all.
Yeah. Don't bite a gift horse in the mouth, or don't
I wouldn't do that. I wouldn't do that either, though. I wouldn't bite a gift horse in the mouth either, though.
No, you wouldn't want to bite them. They can bite back. All right. Well, that does it for us, you guys. Thank you for joining us. And as always, make sure you follow us on social media. You can get us on YouTube. You can get us on Instagram, Twitter, all the different places. Just Google Know Your Risk Podcast and search Know Your Risk Podcast on YouTube. We're not hard to find. Anyway, have a great day and a great evening. We'll see you again tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.